Joining us now, Gareth Stobie from Grindrod Investments. Gareth, appreciate your time this evening. We're talking about the Grindrod Diversified Preference Share Fund, and I'm the first one to admit that we don't give preference shares enough time on this show. So I'm going to ask you to take us to the beginning and give us a lay explanation of what we are dealing with when it comes to a preference share.
Sure, Bronwyn. I think the best way of explaining it is that it's really a hybrid between a debt instrument and an equity instrument. It's equity from a point of view that it's a permanent share on the company's balance sheet, certainly the preference shares that we look at, so they're raising long-term capital for themselves. It's equity from a point of view that the cash receipt that you get on the investment is a dividend, and it's tax exempt because it's a dividend. But it's like debt from a point of view that there's a contractual yield that the preference share pays. So let's call it 9% or 10%. So as a preference share investor, you're investing in a share, it's an equity instrument, yet it pays you return like debt, and you're investing for a long period of time unless you sell it in the open market.
Why don't we talk about preference shares? Why don't you bring them up? You're on the show every single week.
It's so simple. We manage pension fund and long-term insurance money as an asset manager. It doesn't pay us to hold a preference share because we don't get a tax advantage from it. So we just generally just don't look at the preference share market. But I mean, obviously there's opportunities, and especially, you know, in the financial crisis, some of these preference shares were trading at massively high yields. But Gareth, just from my side, I mean, what is the resolution on the tax on preference shares? Because this has been an issue now virtually as long as what I can remember.
And we do have clarity now.
There's clarity enough for me to comment, I guess. Look, there are two tax issues that one is facing when they make a preference share investment. The first is the replacement of secondary tax on companies with the new tax on dividends. Now, that's a tax that is affecting all dividends, whether you're receiving your dividend on Anglo American or you're receiving your dividend on a Standard Bank preference share. So that is really the replacement of one tax for another, and that tax stays the same. 10% used to be paid by the company, next year it's going to be paid by the shareholders. Now, the dividend, the preference shareholders got a bit of a fright because they said, oh my gosh, I thought I was going to get 10%, now I'm only going to get 9%. However, in the preference share market, again, the preference shares that we look at, there's contractual protection for the shareholder. In other words, this time next year, the companies are going to be paying 10% higher on their dividend yield. So once you pay the 10% tax, you're going to be your economic effect is going to be neutral. So that's the one tax cloud that's hung over preference shares, and it's quite ill understood by the broader retail market. The second issue has been this new draft taxation bill, which has been in the press quite a bit over the last 2 months, wherein National Treasury said, well, they're concerned about various aspects relating to preference shares. In particular, they're concerned about instruments that effectively convert interest into dividends. That's their primary concern. Interestingly, though, when it comes to perpetual preference shares, again, the ones that we concentrate in our fund, really, all the listed prefs, all the perpetual prefs, I'm using the terms interchangeably, fall outside of that legislation because there's no redemption date. All of the
Can I ask you a perpetual preference share?
Yes.
In terms of perpetual?
So the company issues a share for, say, $100 and makes no undertaking to ever repay the capital. Goes on into perpetuity. Whereas some of the prefs in the market are redeemable, they have a finite term, and those are really the ones that have fallen into the draft taxation bill, various rules relating to how those preference shares...
People paid you a lower dividend, but then gave you a capital, paid you back 105 Rand for your 100 Rand, and this was called a dividend. And it wasn't... And so there was... I mean, there's been a lot of... This has been in the market for a long time because these preference share funds took in serious money a couple of years ago. I mean, they were cleaning up from the money market funds because of this aspect. And then... The receiver didn't legislate against, but they just said, listen, watch out for this, and people actually stop taking money in because of this uncertainty. So, once uncertainty is out the way, we can all go forward again.
Yeah, but if I can interject there, I think what's important is that they're good preference shares as a whole are not a bad thing. No, it's when they are used inappropriately in some elaborate structure.
So who should be investing in this fund specifically?
So that fund, we are investing in the listed preference shares. They're in the public domain, and they're aimed really at investors with three goals. Those that are looking for income, primary, that's the primary goal. The listed prefs are on average yielding you about 7% tax-free at the moment. They're investors who've got a conservative view on capital. They're looking for capital preservation. And lastly, as Wayne pointed out earlier, they're people who have got a high tax burden in their lives. So high net worth individuals, they're receiving a lot of interest income during the year, and they've got a high tax burden. With preference shares, you're not paying any tax on because it's a dividend, and dividends are bad.
So that's the biggest draw card, in your opinion,
it's a tax
efficiency.
Correct.
Yeah.
Correct.
I know the market reasonably well. I wouldn't claim to have an expert in this, but I know the market reasonably well. What happens if you have a big redemption? Because I know sometimes the traded value of the instrument,
yes,
the capital value, you have got some capital risk if you've got to roll your investment because of a disinvestment.
Correct. I think, look, liquidity is one of the downsides of the asset class, there's no doubt. The listed pref market has got about 26 billion under management, or listed market caps. Of that, the big five banks make up the lion's share. So tradability within those instruments is sometimes not what we would like, certainly as fund managers, but it's not insurmountable, and sometimes it actually works to your advantage as well.
We are running out of time, and I want to touch on your top 5 holdings. So
sure,
if we can quickly touch on that, and I know that you've also thrown forward to Discovery and Able. Perhaps you can just choose what you want to talk about in your top 5, taking into account also Able and Discovery.
Well, let me tell you about some of the current affairs in the market at the moment. Over the last 3 months, it's been quite exciting. We've had 3 different listings in the listed pref environment. Last month, Investec PLC, their London business, issued a local preference share. Came out at an incredible yield, 95% of prime, which is, prime's a 9%. That's nearly a 9% tax-free yield, which is excellent. A touch misleading because that's already including that STC gross up that I spoke about earlier. It was fairly well supported. They raised about 200 million in that issuance, and we as a fund took up a good portion as well. This month, in fact, the book build closed today. African Bank raised a preference share, topped up their current issuance of preference shares. Again, the yield on that was excellent. It was 87% of prime, just over. We've got yet another listing. Discovery is coming to the market with a preference share paying 85% of prime. So these are all blue chip companies raising preference share finance, and we're getting good yields from the instruments.
Gareth, thank you so much for your time. Gareth Stobie joining us from Grindrod. Well, CNBC Africa has launched the All Africa Business Leader Awards that celebrate exceptional leadership in business in Africa. Nominate your leader of choice today by going to abla2011.com. The closing date has been extended to July the 31st. As I said, Gareth Stobie from Grindrod Investments joining us, and of course my co-host Wayne McCurry from RMB Asset Management. A big thank you to you, sir. That's it from me. Send us your comments and feedback. Our email address, businesstonight@cnbcafrica.com. After the break, join us for Hot Stocks.